Good morning and welcome to your daily solo 401k webinar Q&A session with my solo 401k financial, where we help you to stop overpaying taxes and start building real retirement wealth. Today's topic: what counts as earned income for solo 401k? So most people think they know what earned income is until they start exploring a solo 401k plan. But here's the truth: one misunderstanding can cost you tens of thousands in tax advantage contributions or derail your mega backdoor Roth strategy entirely. Your entire solo 401k contribution limit, employee, employer, and even voluntary after-tax solo 401k contributions as part of the mega backdoor Roth is built on one foundation: your earned income from self-employment activity. So today we're going to break it down. As always, this is your chance to ask questions and get answers. Use the chat to ask questions on today's topic or anything else for that matter. Type them over now so that we can be sure to get to them all. Let's continue here. So before we delve too deeply here, let's first discuss the solo 401k eligibility requirements. So in order to open a solo 401k plan, you have to be self-employed. That's why it's called a solo 401k, because it's for owner-only businesses. Your business cannot employ any non-owner full-time W-2 employees who work 1,000 hours or more in your business. Obviously, if your business is taxed as an S corporation, you're going to be a W-2 employee. So that 1,000 hour requirement doesn't apply to you. It applies to someone who is not an owner in your business, but rather a common law W-2 employee. If that individual works 1,000 hours or more in your business, then you would not qualify to open a solo 401k plan. And you have to carry over that test to other businesses that you may own. And we'll talk about that more in other slides here today. That's part of the control group regulations, where you have to look at all of your self-employed businesses. And if any of those businesses employ a full-time W-2 employee who works 1,000 hours or more, and if he or she is not an owner in the business, that would preclude you from being able to open a solo 401k plan. So those control group regulations are pretty complicated. Now, you can always exclude anyone who's under age 21, regardless of how many hours they work in the business. So if someone's under age 21, if they work 1,000 hours, 500 hours, or 2,000 hours a year, you can exclude that individual because he or she needs to be age 21 in order to participate in the plan. You can always exclude contractors in your business. So you may employ contractors in your business. It doesn't matter how many hours they work, you would still be eligible to open a solo 401k plan. So that's important to know regarding eligibility requirements. So let's continue breaking down what counts as earned income for a solo 401k. So anytime you want to open a solo 401k or make contributions to the solo 401k, you have to have earned income from self-employment activity. So contributions to the plan have to be based on earned income from your self-employed business. So, for example, the Contributions to the solo 401k plan consist of employee contributions, employer contributions, and voluntary after-tax solo 401k contributions. If you want to make any type of contribution, you're going to have earned income from your self-employed business. Also, regarding how contributions are calculated for solo 401k contribution purposes, that's going to be driven by how your self-employed business is taxed. So different business types calculate earned income differently. For example, for sole proprietorships, if your self-employed business is a sole proprietorship or an LLC tax as a sole proprietorship, or if you're a contractor, a 1099 NEC contractor, then you're going to need to file Schedule C. You're going to use line 31 of that Schedule C. That's going to be the starting figure for the annual contribution to the solo 401k, whether employee contributions, employer contributions, or voluntary after-tax solo 401k contributions. If your business is taxed as an S corporation, that's going to be your contributions are going to be driven by box 1 of your W-2 from that self-employed S corporation. That's the gross wages box. For a partnership, it's going to be line 14 that has a code A of your Schedule K1. So this slide here shares pages from our website that you can refer to for more information and a complete breakdown. Here's another slide here that talks further about each self-employed entity type for making contributions to the solo 401k. So as we cover this already, for a sole proprietorship, the starting figure for the calculation is line 31 of that Schedule C. Then you have to subtract 1/2 of self-employment income tax from line 31, and then you perform the calculation. We do have a contribution calculator on our website that you can utilize for calculating contributions. If you're a client of my solo 401k financial, we'll actually perform calculations for you as part of the ongoing support. We'll just need to know the applicable earned income from self-employment activity, the types of contributions you want to make, and we'll run calculations for you. That's all covered as part of our ongoing compliance support. We'll talk more a little bit later. For those who are looking to open a solo 401k plan for the first time, all of the compliance support that we offer, whether it's Form 5500 Easy preparation, Form 1099-R preparation, consulting on the rules and regulations, whether it's contributions, distributions, transfers, investments, and so forth. We do it all here at my solo 401k financial, with the exception, of course, of we don't sell investments, we don't provide investment advice, we don't hold our clients' funds, and that's probably why we are such a popular solo 401k provider, especially not only on the retail side, but on the institutional side. We have a lot of advisor clients that utilize our services for their clients, and they'll open up institutional accounts, whether it's an Altruist, Fidelity, Schwab, Interactive Brokers, LPL, depending on who they clear through. So on the institutional side, we have a lot of advisors that utilize our services for their clients, even CPAs and attorneys. Now let's continue here. So from an S, so we were talking about earned income for different entity types. We've already talked about this, but let's keep talking about it. For an S corporation, here's a good slide that breaks down how to calculate contributions when your business is taxed as an S corporation or even as a C corporation. It's going to be based on your W-2 wages from your self-employed S corporation or C corporation. That's going to be the starting figure for the calculation for making solo 401k contributions, whether employee, employer, or voluntary after tax. Here's a good slide that talks about partnership. A business tax is a partnership. Again, it's going to be line 14 with the code A of your Schedule K1, and you have to subtract 1/2 of self-employment income tax from that figure. to calculate all the contribution types. All right, it looks like we've got some questions here. Let's take a look at those, and then we'll go ahead and turn back to our topic here. Here's a question. If I close my company, what happens to the investments? Like real estate, do I get penalized? Good question. And we've covered this topic at great length in multiple webinars. Let's talk about that, but you can also subscribe to our YouTube channel where we have over 1,000 different videos, and you can find specific videos on this topic as well as other topics. But once you start being self-employed, that means you have to close the plan down, because you cannot have a 401k if there's no business. So it's different than a full-time employer plan. Let's say you participate in the Microsoft 401k plan and you separate from service. Well, obviously, by you separating from service from Microsoft, that doesn't mean that Microsoft is shutting down. So the Microsoft 401k plan continues. Well, compare that to a solo 401k plan, which is for a self-employed business. If your self-employed business closes, there's no business. So therefore, if there's no business, there can be no solo 401k plan, which means you would have to transfer the plan to an IRA. If the plan holds alternative investments, whether it's cryptocurrency, precious metals, real estate, trust deeds, promissory notes, private equity, even stocks, then you would open up a self-directed IRA that allows for real estate and those other types of alternative investments I just mentioned. Now, real estate would get transferred in kind. It would get assigned from the solo 401k to the self-directed IRA. So you would work with the county recorder to have that property assigned from the solo 401k in the name of the self-directed IRA custodian for the benefit of your IRA. Then we would need to issue a Form 1099-R and a final Form 5500 Easy to formally close the plan with the government. So if you're a client of my solo 401k financial, we would obviously shepherd you through that shutdown process. So a good question. So no, it would not result in paying taxes or penalties. It would be reported as a non-taxable in-kind direct rollover from the self-directed solo 401k to the self-directed IRA. My son is turning 21 this month, and he's a realtor. Can he start a solo 401k and make contributions for this year? Good question. So yes, if we're talking about eligibility purposes, where you're looking to open a solo 401k and the individual is age 21 or younger, that individual is eligible to open a plan as long as he's between ages 18, or as long as he or she is age 18 and up. So in this particular question, yes, your son clearly qualifies to open a solo 401k since he's a realtor. And if he's a realtor, he may be doing self-employment activity under an LLC, or maybe he receives a 1099 NEC in his name or in his business name. So yes, as long as he doesn't own any other business that employs any full-time W-2 employees, then he would qualify to open a solo 401k plan. Does he have to open an LLC for that, or can he use 1099 without opening an entity? I think I answered that already, so good question. So no, you don't have to open up an LLC in order to be self-employed. What matters if you're self-employed, or what determines if you're self-employed, is the actual underlying activity. In other words, you have to be doing the work, the material services. You have to be performing material services. So if he receives a 1099 NEC in his name, then yes, he qualifies for a solo 401k. If he opens up an LLC, then the 1099 NEC would be issued in the name of his LLC, and he would still be able to open a solo 401k plan. So in short, he can open a solo 401k plan whether based just on 1099 NEC, which he would file a Schedule C, or if that 1099 NEC flows to the LLC. Okay, good question. So thanks for all the good questions. If this information is helping you to feel more confident about your future, please take a second to like and subscribe. It tells the platform this content is valuable, which helps other solopreneurs like you to find it. Subscribing also guarantees that you receive notifications of all our crucial content that we deliver every day to help you secure your retirement. For example, we'll be going live again here in a couple hours. So if you don't get a chance to ask all your questions, no worries. Here in a couple hours, you can ask them at that time. So let's continue with today's topic, which is what counts as earned income for solo 401k. Now, so we talked about the type of income that qualifies and the various entity types. Now let's talk, it's just as important to understand what types of income does not qualify for both solo 401k eligibility purposes. So in order to open a solo 401k, as well as for making annual contributions to the solo 401k plan. So rental income does not qualify unless you're doing the work, you're doing the material services. For example, let's say that you own multiple properties that you manage where you are doing the work. You're collecting the rent checks. You might even be getting your hands dirty and fixing a leaky toilet or putting a fresh coat of paint. Um, so that would qualify because you're doing the work. You're performing material services. So that type of rental income qualifies. Of course, in the context of properties owned by the solo 401k that are rented out, you're not allowed to do work on those properties. So that's not considered earned income. That would be prohibited for you to be performing work on properties owned by the solo 401k plan. So that doesn't count. This would be real estate owned by you personally or real estate you may own through an LLC that you've set up for liability protection purposes, but you're still doing the work on those properties. So that's outside the plan. So don't confuse that. Other types of income that does not qualify are capital gains. So if you receive capital gains from your stock investments, that's not considered earned income because you're not doing the work. That income was not generated because of your material services. Dividends does not count as earned income, nor does interest income. Pension income does not. So if you receive checks from your pension, that's not considered earned income for self-employment activity purposes. Yes, it's taxable income in the eyes of the law, but it's not earned income for solo 401k eligibility purposes. Same thing with Social Security wages. That doesn't count. So when you get Social Security payments, that doesn't count as earned income. Yes, it's taxable income, but it's not considered income from material services performed. Same thing with distributions you may receive from your S Corp or C Corp. That's not considered earned income either. Neither is passive K1 income. It's got to be earned income. So very important. Let's talk about some special scenarios here. So a sole proprietor earning $90,000. So if you're self-employed as a sole proprietorship, so whether you're a contractor or you have an LLC tax as a sole proprietorship, your contributions are going to be based on line 31 of that Schedule C, which is the net earnings from self-employment activity. That 90,000 is what would be used for calculating all your contributions, employee contributions, employer and voluntary after-tax contributions. If your business is taxed as an S corporation, you pay yourself 60,000 in W-2 wages. That's the amount that would be used to calculate all your contribution types. For example, if you make a voluntary after-tax solo 401k contribution, you could contribute the entire $60,000 as a voluntary after-tax solo 401k contribution, and then immediately convert it to the Roth solo 401k. You also cannot contribute more than you make. So in this example, if you make $60,000, even though the overall contribution to a solo 401k plan is $70,000. For tax year 2025, for example, you would not be able to contribute the entire 70,000 if you only make 60,000 of W-2 wages from your self-employed S corporation. So the punchline is that you cannot contribute more than you make, and you cannot contribute above the overall contribution limit. We talked about how if you're a real estate agent with commissions or income from your rentals, you would qualify to open a solo 401k. Married couples can open a solo 401k plan, and they can both work for the same business. If they both work for the same business, then the plan will be sponsored by that self-employed business, and both spouses will be able to contribute to the solo 401k plan. If you look at the slide here, here's an example of a two-participant plan. For example, two spouses. Let's say you're both working under the same LLC that's taxed as an S corporation. That LLC would sponsor the solo 401k plan, so that would just be one plan. A solo 401k is a defined contribution plan, which requires that both participants, in this case, both spouses' funds are separately tracked, as well as their solo 401k contribution fund sources. So here it's an example of 6 holding accounts, aka bank or brokerage accounts for one plan, where both spouses are working under the same business. So they could each make employee contributions, employer contributions, voluntary after-tax solo 401k contributions. Hence why there's a total of 6 separate holding accounts to hold their respective funds. Even though the solo 401k plan allows for these various contribution types, especially a plan offered by my solo 401k financial, you're not required to make all these contribution types. For example, you can choose to just make voluntary after-tax solo 401k contributions and then convert those to the Roth solo 401k or the Roth IRA. What is more, one spouse may contribute, the other spouse doesn't have to contribute. What's more, one spouse may make employer contributions. The other spouse may only make voluntary after-tax contributions or a mixture. In short, even though here at my solo 401k financial, we draft a solo 401k plan for the maximum flexibility under the law, whether from a contribution perspective, whether being able to borrow from the plan through solo 401k participant loans, to investing in alternative investments like real estate, precious metals, cryptocurrency, and so forth. You don't have to utilize all those features. You don't lose those features if you don't use them, but they are already built in the plan so that they're there in the event that you want to utilize all those features. Okay, let's see if we have some more questions here. Is the earned income after tax or before tax? Well, earned income is what you pay taxes on. So once you know what your earned income, for example, if you're a sole proprietorship, your net self-employment earned income is going to be line 31. So that's the amount that's going to be subject to taxes, to personal income taxes in the case of a sole proprietorship. Well, a solo 401k plan allows you to reduce your taxable income. In this case, if you're a sole proprietorship, line 31, which is your net profits from your self-employed business. If you make pre-tax solo 401k contributions, whether employee pre-tax or employer Roth, or employer pre-tax or both employee pre-tax and employer pre-tax, those contributions will reduce your taxable income for the year. Whereas Roth solo 401k contributions and voluntary after-tax solo 401k contributions do not reduce your taxable income for that particular year. On the flip side, though, Roth solo 401k contributions will grow tax-free, meaning you're never going to have to pay taxes on those gains. So you don't get a deduction on the contribution, but it does grow tax-free. Whereas if you make pre-tax contributions, you get a deduction when you make the contribution on your taxes. But on the flip side, all those gains are going to grow tax deferred, and you're going to have to pay taxes on all those gains. once you take distributions from the solo 401k plan. Voluntary after-tax solo 401k contributions are also not tax deductible, but the purpose of the voluntary after-tax solo 401k contribution is to indirectly get more Roth funds in your Roth solo 401k by making that voluntary after-tax solo 401k contribution to the voluntary after-tax solo 401k bucket, and then immediately converting it to the Roth solo 401k bucket. So good question. Okay, let's continue here. Get to that slide here. So the mega backdoor Roth impact. That's a very popular feature of the solo 401k plan, especially for high income earners, because again, in order to make any type of contribution to the solo 401k, whether employee, employer, or voluntary after tax, you have to have the necessary earned income from self-employment activity to support that contribution. So again, voluntary after-tax solo 401k contributions require earned income from self-employment activity. So if you're a high income earner, and let's say your business is taxed as an S corporation, and let's say you also participate in your daytime employer 401k. We have a lot of doctor clients, anesthesiologists, attorney clients, CPA clients. They all tend to be high income earners. Those individuals oftentimes participate in a full-time employer 401k, and they max out the contributions to that full-time employer 401k based on their based on their W-2 wages from that full-time employer. And then they'll also have a side business, and they'll open a solo 401k for that side business, and then they'll go ahead and make a $70,000 overall limit contribution to their solo 401k using tax year 2025 contribution figures. So if that individual is self-employed on the side, let's say through an S corporation, and she pays herself 70,000 of W-2 wages from that self-employed S corporation, she can turn around and contribute that entire $70,000 to the voluntary after-tax solo 401k holding account, and immediately convert it to the Roth solo 401k, regardless if she also maxed out her contributions to her daytime job, including employer contributions by her employer. So she could conceivably end up with $140,000 in contributions, $70,000 to her full-time employer 401k, and then $70,000 to her self-employed business by making voluntary after-tax solo 401k contributions. So talk about really supercharging your retirement accounts, especially if you're a high income earner. Okay. So in summary, earned income rules depend on your entity type and whether or not you're doing self-employment activity, meaning you're doing the work, you're performing material services. If you're not doing the work and you receive capital gains or dividends or interest income or Social Security wages, then you would not qualify to open a solo 401k plan. And of course, you would not qualify to make contributions either to the solo 401k. Correct classification maximizes allowed contributions. That's referring to self-employed entity type. It's generally best from a contribution perspective if your business is taxed as an S corporation, because it takes less self-employment income to maximize contributions to the solo 401k when your business is taxed as an S corporation versus a business that's taxed as a partnership or as a sole proprietorship. And that's because an S corporation, you don't have to subtract the W-2 wages from that S corporation by 1/2 of self-employment income tax, like you do for sole proprietorships and partnerships. So it takes less income, less earned income from self-employment activity to maximize contributions to a solo 401k if your self-employed business is taxed as an S corporation or as a C corporation. Here is my solo 401k financial again. We provide a solo 401k plan that allows for all the various contribution types: voluntary after tax, Roth, pre-tax, employee, employer, normal catch-up contributions, super catch-up contributions, you name it. You can also visit my Solo 401k Financial for more resources. Here's a slide here that talks about the various contribution limits, especially if you're looking to open a solo 401k plan here in 2025. You still have time to open the plan. You simply need to sign the plan documents by the end of the year so that you can preserve the right to make all contribution types to the solo 401k plan in tax year 2026 for tax year 2025 by your business tax return due date plus timely filed extension in 2026. Also, here are my solo 401k Financial for clients who timely requested. We'll prepare Form 1099R at no additional cost. That's covered in our annual fee. That Form 1099R, it's used to report distributions, conversions, like the mega backdoor Roth strategy. Also, the Form 5500 Easy, we'll prepare that and file it with the government as long as you timely request it at no additional cost. We'll prepare that and file it with the government again. That Form 5500 Easy applies once the market value of your solo 401k plan is greater than 250,000 in value. So make sure you notify us when your solo 401k crosses that milestone so that we can prepare that for you. We'll also help you transfer any IRAs or former employer plans to the solo 401k. So we provide full compliance support as well. Looks like we've got a question here. If I make 70,000 earned income, what's the max I can legally contribute? Well, if you make $70,000 of earned income, and if your business is taxed as an S corporation, for example, and you pay yourself 70,000 of W-2 wages, you can contribute that entire $70,000 as a voluntary after-tax solo 401k contribution if you're trying to utilize the mega backdoor Roth strategy. On the other hand, if you want to make some employee contributions as pre-tax contributions, you could contribute $23,500 as an employee pre-tax contribution to the solo 401k plan for tax year 2025. And then the difference, up to $70,000, can be contributed as a voluntary after-tax solo 401k contribution and then converted to the Roth solo 401k or the Roth IRA. The takeaway is that you can chop up those various contribution types, but you can now go over that annual contribution limit. All right, that's it for today's solo 401k session. Thank you so much for investing your time with us. Your time is valuable and your retirement future is worth it. If you haven't yet, please subscribe so we can keep building this community. We'll be back here again in a few hours with more crucial content. Have a great rest of the day.